The last part of the unit on trade deals with kind of foreign currency and foreign exchange and how money transfers from one country to another in order to pay for goods and services or capital or other items. So we're going to kind of cover what's called the balance of payments as money transfers around the world. So the concept of balance of payments deals with tracking the money flows of a country. So any country's balance of payments is made up of money flows. So if we're taking the U.S. for example, we're talking about where is the money flowing to and from. So where are the dollars going? So in that balance of payments, we have the current account. So money that's flowing through the current account comes from the sale of exports and imports as we import goods. So anything that we are going through the balance of trade goes through the current account. Any exports and imports go through that way. In the financial account, we deal with purely financial transactions, things like actually just money changing hands or stocks or capital. So anything kind of financial goes along with the financial account. So as you look at a few practice problems, we're going to try to figure out what goes in the current account and what is going to flow through the financial account. So in terms of if the French buy U.S. steel, so that's going to be an export of U.S. goods. And again, we're thinking about it from the U.S. standpoint. So because it's an export, it goes through the America's current account and the French current account for that matter. If we flip it around and say the U.S. buys French airplanes, well, that's going to be an import for the U.S. and that's also going to flow through the current account. When a U.S. company decides to build a factory in France, well, that is a factor of production, and so that money is going to flow through the financial account. You'll get some more practice with this in the Blue Book Activity 7-1, so if you want to pause here and go there, feel free and at least fill out that first column with does that flow through the current or financial accounts. When we look at the balance of payments, we are noticing the flows of money as either credits or debits on those current or financial accounts. So in terms of credit, thinking about extra credit, right? That means extra, so it's going to be in addition to that account. There's going to be money flowing in, so we call inflows. Versus a debit, which is a negative. So if you were to debit your account, you're subtracting, and so that's money going out of the country. And again, whenever we deal with these types of transactions, we're talking about one country's currency, and since we're in the U.S., we might as well talk about U.S. dollars. So if U.S. dollars are coming into the country, that's going to credit the account. And if U.S. dollars are leaving the country to go somewhere else, that's going to be an outflow or a debit on the account and be a negative. Here are the three same problems as before, and I've already labeled them as current account, financial account. And so with each one of these, is U.S. dollars coming into the country, so inflows being a credit, or are U.S. dollars leaving the country, and that's an outflow, which means it is a debit on that account, as U.S. dollars are leaving. So if French are going to buy U.S. steel, that U.S. Steel Corporation is going to want dollars, and so money is going to be flowing into the U.S., and in return, we're going to give them steel. So this would be a credit on the current account because money is flowing in to the U.S. and steel is flowing out. In number two, it's also the current account, but the U.S. is buying French airplanes. And this would be a debit as U.S. dollars are flowing out to buy the French airplane. In the third example, the U.S. is building a factory in France, so the U.S. dollars are going to be leaving the country, and so that will be a debit on the financial account as money is flowing out of the U.S. Lastly, in the balance of payments topic is the idea that the balance of payments comes from the fact that the current account, if we add that value to the financial account, that's going to equal 0. So they're going to balance each other out. So if the current account notices a credit or increases in value, or surplus is sometimes used, then that means the financial account, in order to balance, must be noticing debits. We might talk about it as decreasing, or perhaps in a deficit. So a current account surplus means that there's a financial account deficit. Alright, so I know how much you guys like my drawing, so we'll use one to kind of illustrate the balance part of the balance of payments. And there we are. As you can see, we have the US and Europe across the Atlantic Ocean from each other. And I've kind of labeled the transactions we're going to make as the financial and current accounts. So let's say somebody in Europe wants to buy the US-made t-shirt. Well, people in Europe tend not to carry dollars, and so the first transaction they're going to need, because the Europeans have euros, and the US company selling shirts certainly wants dollars because, as an American, what are you going to do with a euro if you're, in the south suburbs of Chicago? So the t-shirt company wants dollars, but the Europeans have euros. And so the first transaction is simply financial in the sense of Europeans are going to have to send euros to the United States, and the U.S. in return sells them the dollars. We'll talk about these Forex markets later, but just the idea of transacting, that the Europeans are going to be buying dollars, they're demanding dollars and supplying their euros in order to get those dollars. So they sell/supply their euros and they buy US dollars, and so now the Europeans have those dollars that they're going to need to buy the shirt with. So in the financial account, if we just look at this transaction, we're tracing the dollars because we're talking about the financial and current accounts of the United States. So in the financial account, money's leaving, it's an outflow, so it's a debit on the financial account. So the financial account might be in deficit at this point. We can think of it either way. Then in the current account, the Europeans want the shirt, so they send the money to the US, and the US sends the shirt, and everybody's happy. And so in the current account, what ends up happening is there's been a credit in the current account because the dollars flowed into the US. And so money coming in is going to credit, there's more dollars in the current account. And the t-shirt is what left the US and went to the person in Europe. And so this is kind of the balancing act that happens in the balance of payments, is that the United States needs excess supply of dollars to sell to Europeans so that then they can actually make trade with the United States. So if I just take a moment to summarize and kind of simplify these transactions to just focus on the US dollars. The first transaction through the financial account, because it's simply monetary in nature, is that the US dollars flowed out of the US economy through the financial account because nothing was traded other than euros for dollars. Then when the actual goods and services bought with those dollars, the dollars flowed back into America through the current account. And the idea being that the amount of dollars that that person in Europe is going to exchange into dollars is going to be equal to the amount of dollars that they're going to need to buy the t-shirt. So if the t-shirt costs, or has a price tag of $10, they're probably going to sell $10 worth of euros to America to get the $10 to buy the t-shirt that is valued at $10. Ultimately, this goes a little bit farther into just international trade in general, because if we allow for more free trade like we talked about at the beginning of this unit, then ultimately it leads to even more trade. Because now, one thing we haven't yet talked about is that America now has these euros. And so some company, some person, the foreign exchange, the government, somebody has these euros in America. And the only thing you can really do with euros, other than exchange them back for dollars, would be to buy European goods or to invest in European companies or to save in European banks. So ultimately, by exchanging these currencies, the U.S. ends up with those euros, which then it probably is going to turn around and do something with and engage in more trade in Europe. So it helps to increase the level of trade, and we kind of track all of these transactions to just make sure that the financial accounting of the international trade and Forex markets.